Being the appointed hour, I call to order this public hearing here in the McKinnon Council Chambers in Southbridge, Massachusetts on December 5th, 2022. Welcome to the fiscal year 2023 tax classification hearing for the town of Southbridge, Massachusetts. There'll be a presentation, and then there'll be a time for questions from the public at that point. I'm now introducing Ms. Rachel Carney, the Principal Assessor for the town of Southbridge.
Good evening. If anyone wants a packet, Karen Harnice over here has a copy of the presentation, and the council members, if you haven't received one, Michael has those copies. All right. So, good evening, Mr. Chairman, members of the Town Council, Town Manager McCall, and citizens of Southbridge. Tonight, the council will be voting on 4 tax options for fiscal year 2023 that will determine how the tax burden is shared. On behalf of the Board of Assessors, Fran Bosquet, Diane Kokoska, and myself, we would like to present the following information that explains those options and how they may impact property owners in Southbridge. Now that our new growth and the valuation of real estate and personal property have been approved by the Department of Revenue, we are required to hold this tax classification hearing. The reason we hold this hearing is to allow for an open forum to discuss our local tax policies. While we are not setting a tax rate tonight, we will be providing a projected rate. This tax rate still requires approval by the Department of Revenue and is subject to change. Also, due to rounding, the numbers provided throughout this presentation are not precise. The council has 4 options to consider and vote on tonight: whether to have a single or split tax rate, a residential exemption, a small commercial exemption, and an exemption on open space. Now, Southbridge does not currently have any land classified as open space, and the majority of qualifying properties are exempt from taxation or already benefit from the Chapter 61 tax relief program. So a no vote is required for that one tonight. The next few slides will give you a quick overview of the assessor's methods in valuing property in Southbridge. We start by determining if the property is real or personal. And real property is further broken down into 4 categories. We have residential, commercial, industrial, and open space. And personal property is anything movable and not permanently attached to the land or building. Next, the assessors appraise the value for each class, utilizing the best method for each class to ensure a fair, equitable distribution of the tax burden. Excuse me. As you can see by the chart, 81%, hold on a second. Oop, oop, oop. Sorry. 81% of Southbridge's value comes from the residential class, with a total value of $1,254,021,411, and with only 19% of the value coming from the CIP class. CIP is the short term we use to describe the commercial, industrial, and personal property classes. You'll hear me use it often throughout this presentation. Every year, the assessors determine the fair cash value as a result of a comprehensive study of the real estate sales and the rental market for income properties. We also conduct hundreds of property inspections each year to ensure that our data is accurate. The total taxable value for FY23 is $1,553,367,369. And that is an increase of 15.8% over FY22. And this slide breaks it down by each of the classes' changes. So you see the residential value increased by 19.6%, commercial increased by 1.9%, industrial increased by 6.9%, and the personal property decreased by 0.6%. Now with personal property, that reduction is in part due to business closures, but mainly it's due to the natural depreciation of personal property, much like your car. The total value for each of the classes can be found by combining the value from the magenta change magnitude on the slide and combining it with the red fire total amount. This is a year-to-year comparison that shows a single family property that was assessed at $205,100 for FY22 and is now being assessed at $245,400 for FY23. Now, it's important to note that within each different class, different types of properties increase at different rates. So not every residential property increased necessarily at 19%. So it depends on the styles, the neighborhoods, a lot of different factors that overall the property class increased that much. And this example is from an actual property in town. The assessors determine the new growth for the community. New growth is an increase in assessed value over the prior year's value due to new construction, physical improvements, lot splits, or anything new to the tax roll, like the personal property assets of a new business or new assets acquired by an existing business. Without inspections, most of the new growth would be missed or inaccurately valued. An interesting thing to note here is that even though personal property reduced in value, it was a significant contributor to our overall new growth. And in fact, the majority of Southbridge's new growth comes directly from the CIP classes. Next, we determine the tax levy. And this is when the hard work of all the town departments and our counselors comes together. It's a simple calculation to determine the tax levy, as you can see by the slide, but the process to get here is much more involved. First, we need the total budget for the year, which is determined after months and months of meetings to find the best use for the taxpayers' dollars. And that budget is reduced by the receipts that are brought in each year by various departments, selling permits, collecting fees, bringing us to a tax levy of $24,800,771. Excuse me. Under the provisions of Proposition 2.5, the town of Southbridge for fiscal year 2023 would be allowed to raise a maximum tax levy of $26,083,812. This calculation of the maximum allowable tax levy and the levy limit is shown on the slide. Oh, if I switch the slide. So basically, you're taking last year's levy limit, you're going to increase that levy limit by 2.5%, then you add to that the new growth, and that's going to give you your FY23 levy limit. Then on top of that, we add in our debt exclusions, and that gives you your maximum allowable tax levy of the $26 million. So in addition, Proposition 2.5 also mandates that the tax levy cannot exceed the town's levy ceiling. The levy ceiling is 2.5% of the town's taxable assessed value. For Southbridge, the levy ceiling is calculated as follows. I don't have a slide on this, I apologize. It's taking the tax dollar value for this year, for FY23, multiplying that by 2.5%, and that equals your levy ceiling. So we have a levy ceiling of $38,834,104. And so that for FY 2023, the tax levy is below the levy ceiling and the maximum allowable tax levy. Therefore, we meet the constraints of Proposition 2.5, and we can proceed to the calculation of the actual tax rate. In FY23, we are left with an excess capacity of $1,238,041, and that is the additional amount that could have been appropriated but was not. Now the council must decide on how the tax levy burden is shared. With a single tax rate, everyone is taxed at the same rate. A single rate keeps Southbridge competitive for new business relocation, and it maintains the CIP values and stability for our existing businesses. With a split tax rate, more of the burden is shifted to the CIP classes, relieving the residential burden. A split rate could cause businesses to seek other areas to conduct operations, and it could hinder the prospect of attracting new businesses to Southbridge. This chart illustrates again how the levy is currently shared between the classes. And 81% of the burden is carried by the residential class, with 19% by the CIP class. Of the 19% of the CIP classes, the burden falls primarily on the commercial class at 42%. And the commercial class mainly consists of retail and office spaces. Other examples of commercial properties in Southbridge are United Lens, the Hotel Conference Center, grocery stores, nursing homes, banks. So by adopting a single tax rate or a minimum residential factor of 1, the projected tax rate on all properties for FY23 is $15.97 per $1,000 of value. This example shows the impacts to the annual tax bill on a modestly valued home at $245,400. As you can see in this year-to-year comparison, with a single tax rate, the annual tax bill will increase $247.75. If the council were to adopt a maximum residential factor of 0.88, in this scenario, the annual tax bill would decrease by $220.97. So while reducing the residential tax rate by voting a split rate sounds good in theory, the reality is Southbridge doesn't have enough CIP properties to support the tax increase that they would incur. A financially healthy community is one that maintains diversity of property classes and strives for a near equal balance of those classes. Therefore, to intentionally shift the tax burden to the business classes would be short-sighted and counterproductive to our vision for the future of Southbridge. As you can see, the impacts on the CIP class, if a maximum residential factor of 0.88 were to be approved, is significantly higher than the benefit to the homeowner would be. A modestly valued home at $265,000 would save approximately $500, but the impact to the CIP classes would be in the several thousands. A negative impact to the CIP classes could lead to a reduction in our annual growth, our new growth. You okay, Mike? A negative impact to our CIP class would lead to a reduction in our annual new growth. For 14 consecutive years, the majority of our new growth comes from the CIP classes. Commercial properties are valued based on income. An increase to taxes directly impacts the bottom line of the commercial properties, therefore possibly reducing the value of those properties. The split rate is used successfully in large communities with a high ratio of CIP properties and other draw factors such as major highways and ports like Worcester and Boston. If the council maintains a minimum residential factor of 1 with a single tax rate of $15.97, the average residential single-family tax bill would be $4,232.05. And the average commercial bill will be $9,582. And the average industrial tax bill would be $11,179. Currently, Worcester is the only community near Southbridge with a split tax rate. Both Webster and Sturbridge tried the split rate many years ago, but have since gone back to the single tax rate. It is the recommendation of the Board of Assessors that the council approve a factor of 1. This will result in a projected single tax rate of $15.97 per $1,000 valuation for all classes of property. The small commercial exemption. By adopting the small commercial exemption, you shift the burden within the commercial and industrial classes. The amount of the levy remains the same. Personal property is not impacted by this option. To qualify, an owner of a commercial property that is valued at less than $1 million and occupied by a small business with fewer than 10 employees may be granted an exemption of no more than 10% of the assessed value of the property. This discount is granted to the owner of the property, not the owner of the small business, unless they're one and the same. Adoption of this option will result in a higher tax rate for all other commercial and industrial properties. The current language of this law leaves the approval process unfair to deserving similar businesses. One may be disqualified simply for being located within a building that is valued too high, or they may have too many people on staff. But most importantly, the law does not require that the exemption be passed on to the business who actually qualified for the exemption. The exemption is granted to the property owner only. So adoption of this exemption will shift the burden within the commercial and industrial classes, resulting in a higher tax rate for non-qualifying properties. Again, the Board of Assessors do not recommend adoption of the small commercial exemption. And last is the residential exemption. This shifts the tax burden within the residential class from the owners of modestly valued residential properties to the owners of vacation homes, higher valued properties, and residential properties not occupied by the owner. This includes apartments and vacant land. Communities that choose to adopt the exemption often have the following characteristics. They are large cities or towns with a majority of non-owner occupied properties like apartments or vacation homes. Resort communities with many seasonal residents like Martha's Vineyard. Again, the Board of Assessors do not recommend adoption of the residential exemption. I apologize, I forgot to flip the screen if anybody needs to read that. These next three slides kind of give you a breakdown of the impacts to the residential properties. Unfortunately, the calculation tool on the Department of Revenue's site to calculate this uses all of last year's numbers. So this is just going to give you the idea of the ratios and how it would be split, but it's based off last year's values and last year's tax rate. But as you can see, the first slide is if we were to offer a 10% exemption for residential properties. So properties ranging from $30,000 up to $220,000 would see savings. And then everything over $300,000 would see a significant increase to their property taxes. And so what it's doing is it's giving a new tax rate for the exempted properties. It's reducing their value, and then it's attaching a higher tax rate to those higher properties and non-owner occupied properties. This is a very challenging exemption option to implement also, because it's really difficult to confirm who's owner occupied, which properties are actually owner occupied. So this can be a very challenging exemption option to put into place. And this is something that we would have to do before the bills went out this year. So a lot of this would be guessing. So people may get the exemption who don't qualify, or vice versa, not get it when they should have qualified. So we would be dealing with abatements later, after the fact. So I encourage you to really think about this, both residential and the commercial exemptions. If it is something that you guys are thinking about leaning towards, I highly recommend talking about this way before tonight. There's a lot of things to think about, so just something, food for thought. Okay. And that is it. So thank you.
Very good. Thank you, Ms. Carney. At this point, we'll open up the discussion of the hearing for questions.
I'm not so much if it's a question or more of a having, find out exactly to understand. Yeah, I understand some of the scenarios that's been presented. My name is George Shenyon. I live at Teresa Ave. In the presentation, they talk about an increase, a tax bill of increase of $247.57. I just want the people out there not to understand that this is not misleading. It's showing the tax rate for FY 2022 at $17.90 with a tax decrease in FY 2023 to $15.97. But it's really not a decrease because the valuation of your homes went up to make up the difference. My question is, with the added increase of $247.75, does it include the fire station building project that is going to be out starting?
Through you, Mr. Chairman, my understanding is no, not yet.
And I believe that's because these funds are not expended like now.
We're only just beginning, yes.
Right, so next year in FY '23, in all probability, those funds are going to be expended because of the construction project starting. So is that going to be change the tax rate in FY '23, or are they going to prorate it or rate it differently when it comes to '24?
Well, Ms. Harnois could correct me if I'm wrong, but as we start the borrowing for individual segments, we will start to incur costs on the borrowing of those funds. So that's, the first phase would be the acquisition of these properties, and then there'll be some additional monies used for architecture and things, and it won't be until we get into the bulk of the construction that I think that you'll see the larger borrowing, and then those in turn, the principal and interest hitting into the taxes.
So that would probably just show in FY '24.
More than likely, yes.
Okay. My other question that I have is when they talk about exemptions, small commercial exemptions, residential exemptions, and so forth, I don't quite understand, because in the document that they show, it shows impact of residential tax bill with exemptions and without exemption is zero, the same amount of money. But if you, in the explanation, it says residential exemption. The residential exemption shifts tax burdens within the residential class from owners of moderately valued residential property to the owners of vacation homes, high-valued residential and rental properties not occupied by the owner. I know with this council, it's been a concern with the upcoming trash pickup, those kind of things, that multiple family homes that are investors, that they should be paying more than the average homeowner out there that is a single-family home, paying the tax bill, and a six-family home paying the same tax rate for the same service. So technically, it's a single-family home versus a six-family home, both paying the same tax base. So I would ask council to either have further discussion about that residential exemption, to consider having it and making the investors of commercial properties such as the big apartment, 3-family, 5-family, 6-family, and those sorts. So it would shift some of the tax burden to be equally shared by all. Thank you.
Anyone else in the public that would like to address a question? Anyone here at the dais? Councilor Marchetti.
Thank you, Mr. Chairman. I know that we don't have a lot of time left of this public hearing, so I'll save most of my comments for when we talk about it at the council meeting. My only question is the way how they assess the properties. For instance, multifamily housing, I have heard rents in this town have skyrocketed upwards of $1,900 a month, which is why I don't understand why a 2-3-family house, according to your chart, is still assessed at a lower value than a single-family house. Certainly my house, little 3-bedroom house that I have, cannot be worth as much as somebody who is charging $1,900 a month for each apartment, three-bedroom, three-decker apartment somewhere, and many of them, not all of them, but a lot of them are absentee landlords. So I'm not quite sure how we get to this assessed value, except the only thing I can tell is that you're basing it on sales and sales only. So if someone is charging that much for rent, it seems to me that that should be taken into account. But I'll save the rest of my comments for the
Very good.
tonight meeting. Thank you.
Thank you.
May I-
Would you like to address?
May I answer?
Certainly.
Depending on the multifamily, we do look at income, but we also look at sales, especially when it comes to the smaller residential units like 2 families to 4 families. There's a lot of sales of those currently, lots. So we do have a lot of data. Sales are the most accurate way to value a property. It is what the consumer is willing to pay. That's your value. It's the most accurate. Unfortunately, the rental income forms that we send out, the I&E forms, we have a very low rate of return. That's where our rental study comes in. So we have limited data, and especially with the smaller homes, residential, the return rate is very, very low. We do get returns more from the large commercial properties, because they know, they report to the state level, so they just automatically report to us. But for 2, 3, 4 families, we often don't get those returns. So it's very difficult to use the rental study, but we do analyze all that data. We look at everything from every angle we possibly can. But this year, in fact, I have the breakdown. I apologize, I don't have it with me. Thought I had a count on the multifamilies, I don't. But we had significant sales for those lower count even unit counts. So we were able to really get an accurate number on those. So I hope that answers your question.
Council Steves.
Thank you, Mr. Chairman. Rachel, I had a quick question, kind of following up on what Councilor McKinney asked. And that's specifically, I know you said it would be difficult to do this, but would it be really useful for us if we could break down the property sales between owner-occupied properties and investment-type properties? Because I know you mentioned it's somewhat difficult, but I know that we have an awful lot of, especially 3 and 4 family type properties who are owned by a relative handful of landlords. They're definitely not owner occupied.
Well, a lot of 3 families in this community, though, are owner-occupied.
Some of them are, yes, some of them are, absolutely.
That's where the challenge lies, for me to distinguish between where does that owner live.
Mm-hmm.
It's not like I have a classification code or I can plug that in. It comes more from knowledge of the properties.
Right.
So when I'm processing things for different exemptions, veterans exemptions, that's where I'm seeing they're multifamily, but they're owner-occupied. Single families, there's more of an assumption
Right, sure,
of
and that's understandable. Yeah.
owner-occupancy, but that doesn't mean it's owner-occupied.
No, that's true.
A lot of people rent out in single families, but we tend to assume that they're owner-occupied. But again, to verify that is very challenging. Yeah.
So, because I know you mentioned earlier that if we were to assume a residential exemption, then they would be able to seek an abatement after the fact.
We are capable of doing that. So
Yes.
if we miss somebody who's an owner-occupied, they would have to come in and prove that they live there. They would need to show tax returns showing that that's their primary residence.
Right, and I understand that.
Yeah.
And I think that we'd probably see fewer of those than we would see the multi-ownership situations where
Yeah,
they
my-
might have one home where they actually live in and 15 that they own.
Yeah, so, and that's, the problem is that if I don't guess right from the beginning, then I'm not shifting the burden correctly. And by abating them after the fact, I haven't shifted the burden correctly. So that it gets really tricky and challenging. It's not means tested. It's such a broad type of exemption. I believe only like 5 communities in the state use this residential exemption. There's a lot of other options. There's now the new senior circuit breaker.
Right.
We do offer a senior discount
Right.
for income qualifying people, widows, veterans. So that, there are a lot of options for people who need help, but there may be other things we could look into. This particular exemption is just really, it's a tough one to try and implement on a property. And then I understand people want to tax, the multifamilies and the apartments, but you also have to look at the big picture, is that your impact to the higher valued homes is going to be significant.
Right.
Significant. Yeah.
And also, during your talk, you mentioned that Worcester's the only property, the area that does the
The split rate?
that does the split rate. And
Yeah.
I thought Auburn did too. Your text says that it does. And I know they
Don't
did
know
as
that it
a
looks
few years ago,
specifically
but I don't know if
at
they still do.
Auburn. Let's see, other towns.
Because the text that you sent us says Auburn too.
Yeah, I don't have Auburn on my list, so,
And I know they used to, but I don't know if they still do.
but it's possible. There are a larger population there, so, yeah.
Okay, thanks.
Okay.
Anyone else? Very good. At this point, I'll close the hearing, and we'll be a couple of minutes, and then we'll start the regular town council meeting. The hearing is now closed.
Nice picture. Did you use that?